Hey, good. Hello, everyone. Every time you look into the technology, you see something different, but let me welcome you, despite this little bit surprise of myself, how the screen looks like now, to this first CEE Swiss Impulse session of 2026. We are very happy to kick off this webinar series once again. The idea behind it is that we always wanted to create some kind of a TEDx talk for the Central Eastern European region, together with our partners from the Chambers of Commerce in the countries to inspire people to give you access to new know-how, or in this case also to new economic outlooks from Switzerland's second largest bank, the Zürcher Kantonalbank. Before I hand over to our speaker today, as usual, I'd love to make a very brief introduction. And I'm switching quickly to my slides. So anyway, as I mentioned, what we try to do as Chambers of Commerce is really to facilitate better relationships between Switzerland and the 17 countries of Central Eastern Europe. We try to do this in terms of business, but also in terms of scientific collaborations, but also in terms of education. And this is a little bit a part of an educational element. It's not about educate, but really bringing you cutting edge know-how. And we do this not alone, us, the Chamber of Commerce, Switzerland, Central Eastern Europe. We are based in Zurich, in Switzerland, but we do it together with our partner organizations that you see here on the map, and I thank them for the collaboration, and they are also co-hosts together with us. Yes, so some points in regards to the meeting today. You are on mute. You shouldn't have any videos. We will. Oh, this is an old one. Oh my God! Don't read the text. So I'm gonna jump to the next one. But you will be able to ask questions. Do this, please, by using the Q&A button, or just write into the chat function if you have any question to ask to Martin Weder about the economy, about investments, about how your country is doing, about sectors, and whatever question you might have. Please ask that question. As usual, he will talk about 25 to 30 minutes. Then there will be plenty of time and for question and answers. We will stop at 11:45. If there are more questions, I'm sure we will have time to also answer them, but the people who want to leave can, of course, leave at any time. You will get the video, you can review it, and we will also send the slides. Just talking about the next webinar that we will have, it will be about, again, one of our favorite topics, about the future of mobility. Christian Bach, he's from the Center of Material Science. This is a terrific world-leading institute. And he will talk about the question, what will it be electronic mobility? Will it be hydro-powered mobility? Will it be oil? Will it be something else? And how will that work? So this is really going to be very interesting, and I'm looking forward to this one in March. Okay, good. Now let me also introduce very quickly today's speaker. He's a regular, and I'm very happy also not only that Martin gives us the honor to speak to us always at the start of the year, but also that we have a really great relationship with ZKB, who are also sitting on our board. Now, Martin is the chief economist and head of economic research at ZKB. He is an important part of ZKB's CIO office, and his team is responsible for analyzing and forecasting macroeconomic monetary policy and geopolitical developments. Before joining ZKB, the Zürcher Kantonalbank, the Cantonal Bank of Zurich, in 2018, as senior economist for Europe, he worked at the Swiss National Bank in the area of financial market analysis and as a research associate at Economist Swiss, the umbrella organization of all Swiss industry associations. He holds a PhD in political economy from the University of Lausanne and an MA in economics from the University of St. Gallen and Sophia University in Tokyo. So, Martin, the floor is yours.
Thank you, Oliver, for this kind introduction. And hello, everyone. I'm glad to be back for this Impulse session. I believe it's now the third time that I'm able to provide you with a global and a financial outlook. And as usual, there's a lot of ground to cover, a lot of topics, hot topics, not only related to economics. I'll also talk a little about the geopolitics and AI. You cannot have an outlook without those two important issues. So let's get started. And I'm also looking forward to the discussion and questions that you might have afterwards. So these are the slides. Hope you can all see them. So, and what's today's agenda? So there are three parts to the presentation. I'll start with the general global economic outlook, while of course also focusing on Central and Eastern Europe. Followed, as I mentioned, by geopolitics. A lot has happened in terms of geopolitics in 2025, and more is likely to happen in 2026 and going forward. And then also artificial intelligence, a big driver not only of the general economy, especially in the US, but also of financial markets. I'm not really an expert in terms of AI, but I'll give you an economist's view on AI. As I mentioned, in terms of economists and strategies, this topic is with us, has been with us for a while, and we get a lot of questions from clients regarding our view on AI and market potential. So I'll also talk a little bit about that, and then close with a brief summary, which will turn to be quite optimistic actually. So our outlook, you can always talk about whether the glass is half full or half empty, and we're definitely in the half full camp. But I will come up with some arguments why we are rather optimistic despite all those geopolitical, generally political challenges that we see around the globe today. So let's get started with the global economic outlook. And overall, we are rather optimistic or cautiously optimistic for the world economy as a whole, not necessarily for all countries and regions, but overall, we're optimistic because actually the most important leading economic indicators, sentiment indicators, they're actually quite robust, they're strong, and they actually tend to increase overall. And you see that on the left-hand side, the composite leading indicator by the OECD, the Organization for Economic Cooperation and Development, but also the Purchasing Manager Index, the global one. So asking firms around the globe, both for manufacturing and services sectors, what the current situation and the outlook is. And overall, we're more or less on zero, which means growth should be around the long-term average. Some indicators are even above zero. So actually, the picture is much better than when you read the media, you read the news every day. So maybe that's this one positive take to start with. And then the second point I'd like to make is on the right-hand side. Economic data have come in better than expected, and they've come in better than expected for quite a while, actually more than a year now. That's quite unusual. And here again, if you look at the media, with trade conflicts, geopolitical events, even the start of the year has been very turbulent with the US military intervention in Venezuela, then the talk about annexation of Greenland, unrest in Iran and other countries. But nonetheless, the world economy as a whole has held up better than expected. And I'll try to mention some reasons why this has happened. But overall, as I said, it's actually quite a good and encouraging picture on the world economy. So our outlook is here, the GDP growth forecasts, they're actually quite unspectacular. They look quite similar than they were a year ago, if you remember that. So the dots indicate the 10-year average, and you see that in most countries and regions we're close to the long-term growth average. The US economy has definitely outperformed once again in 2025, so that was perhaps the biggest surprise, especially after Liberation Day. Many economists turned pessimistic. US recession risk was elevated, but after all, the US economy once again grew by more than 2%, and you actually expect some acceleration this year to around 2.5%. And the good news is also that finally Europe is waking up again, especially with Germany, the largest economy in Europe, turning a corner and finding finally some growth again. So that's encouraging too. And then also emerging markets, especially outside China, where growth is quite robust and high, continues to be higher than the long-term average, and makes up for the structural slowdown that we continue to see in China. But overall, actually quite a good picture. You see on the very left-hand side, the global perspective, we're below the long-term average, but this has to do with the slowdown in China. Overall, growth is moderate. So not spectacular, but moderate, but also quite robust. So for 2026 and 2027, despite all the turbulence that we see at the political level, we're actually quite optimistic for the world economy as a whole. So what are the reasons for the surprising resiliency of the world economy that we saw last year and that we think we'll also see this year and next year? So I mentioned that economic data came in better than expected, and one reason for that, as you can see here at the top, is obviously that expectations were quite low, and there was a bearish sentiment after Liberation Day. So we had financial markets collapsing, especially the equity market took a big hit. There was very high political uncertainty. Nobody knew whether US President Trump would follow through with his tariff threats and what the reactions would be of the most important trading partners. So part of the reasons why data were better than expected was, of course, because expectations were very low. But then again, there are also more fundamental structural factors for the resiliency. One of them was that there was surprisingly little retaliation against the US trade policy. So Trump didn't do everything he threatened. He backtracked somewhat after financial market turbulence, but nonetheless, US tariffs were put in place. They're now at the highest level since the 1930s. So you have to go back quite a few decades where you had that much protectionist measures put in place in the US. But with the exception of China, most countries didn't retaliate and even agreed to quite one-sided, what Trump calls deals. They're not really deals, they're more or less agreements or intentions, but nonetheless very little retaliation. And that, of course, helped against that pessimism. And then the other important factor, of course, artificial intelligence continues to boom, especially CapEx expenditure by the biggest tech firms, a strong increase in 2025 and an even stronger one in 2026. So this is a fundamental driver, not only of investment, but overall economic growth in the US, but also in the rest of the world. And you also see it in the trade statistics. Despite the tariffs put in place by the US, trade was actually doing quite well, and a lot of that has to do with semiconductors, especially semiconductor exports from Taiwan to the rest of the world that are still booming significantly. Another important factor was fiscal policy, because fiscal policy remains expansionary, especially in the four largest economies of the world, that is US, China, Germany, and Japan. Together, they are responsible for 50% around of global output. So this is significant if those four economies are loosening fiscal strings. So that means government expenditure is rising and taxes tend to be lower, especially in Japan and in the US, whereas in Germany, it's mostly fiscal expansion on the expenditure side through higher infrastructure and defense spending. And we've also seen some tailwind from monetary policy after the significant rate hikes in 2023, 24. We now have seen some rate cuts, and we will see some more, at least according to our forecasts, especially by the US Federal Reserve and then also in some emerging markets. And that, of course, not only helps financial markets, it also helps businesses and households because interest rates on mortgages, on business loans tend to fall as well. And this is also providing some tailwind. So when we turn to Central and Eastern Europe, the picture is a bit more mixed. Overall sentiment remains rather muted. You see here the economic sentiment indicator by the European Commission. It's still below the long-term average of 100 points. So the picture is quite similar to what it was 1 year ago, but the recovery that we expected didn't really happen. What has also changed was the pecking order has changed. Last year we had Estonia at the bottom and I believe Bulgaria at the top. And now it's Lithuania and Romania. But overall, as I said, the picture quite unchanged. But the good news is if you look at the euro area as a whole, and of course a very important member or even trading partner of Central and Eastern Europe, you see the picture is a bit better. The economic sentiment indicators more recently has ticked upwards and is now very close to the 100-point average. So we expect a cyclical recovery in 2026. We believe the recovery was only delayed by the whole tariff threats and geopolitical events. It was only postponed, but now, especially with fiscal policy in Germany, we expect a cyclical recovery, and that recovery will also be driven finally by the manufacturing sector, who has been struggling for just about 3 years, so a very long drought. But manufacturing firms finally seem to turn the corner, and they are receiving more orders from month to month. So this is good news, not only for the euro area, but I think Central and Eastern Europe will also benefit from this cyclical recovery in Germany and the rest of Western Europe. And these are the forecasts for 2026 and 2027. Again, even for these countries, they look very similar than they did a year ago. But then if you look at 2025 numbers that came in, they actually, in most cases, were lower, in some cases significantly lower than what we and the consensus expected a year ago. And some of this has to do with tariffs, trade conflict, because some of those countries tend to be quite open and highly connected with the rest of the world. So, of course, trade conflicts didn't help, but I think also general political uncertainty dampened investment. So investment in many cases was much weaker than expected. And then what also hurt those countries more than Western Europe was in some cases another increase in inflation, or generally higher inflation than in Western Europe, sometimes driven by energy prices, but also by rising wages and persistent service inflation. So this also hurt the consumption, and especially in countries like Hungary, Romania, those factors significantly affected economic growth. But we also had some success stories, especially Poland and Czechia. They continue to be very dynamic and resilient despite all those turbulence at the global level. So overall, a bit of a setback or disappointment in terms of economic data. But again, I think this is just a hit in the road, but we think the recovery will just about start in those countries as well, and we see some acceleration in economic growth in the following months. So in terms of inflation, here also generally is a good news, a good picture. Price pressure has normalized almost everywhere. Some exception in advanced economies is the UK, that you can see on the left-hand side, where inflation is still elevated. Similar story than in some Central and Eastern European countries in terms of wage inflation and services inflation being the main driver. But in the US, actually, inflation came in lower than expected, so tariffs haven't really had that much of an impact. That's surprisingly good news. We and many others expected that goods prices would increase because of tariffs. That has happened only to a small extent, meaning that US companies and importers were taking a hit on their profit margins, perhaps sometimes also not to infuriate US President Trump with further measures. So that's good news from a consumer perspective, and perhaps less so from a firm perspective. But overall, profit margins remain high, so even despite the tariff hit, the overall picture is still good. In Central and Eastern Europe, the picture is quite similar. We have one notable exception with Romania, where inflation has risen substantially. Some country-specific factors like electricity prices that have risen substantially due to regulatory changes. And then also we've seen a strong increase in the value-added tax that has also led to this increase in inflation. So fiscal policy, energy policy playing a role here, but overall, as you can see, most countries still slightly elevated inflation rates, but we should see further rate cuts in some countries as well, and that will also further help to support the recovery that we see. So we turn to the forecast for inflation. As I said, a similar picture. So the Romania's one-off factors primarily driving inflation in 2025 and 2026. But we should be back to normal more or less in 2027. And here once again, Poland and Czechia stand out as being quite resilient and stable in terms of growth and in inflation. And then the other members that are part of the euro area, of course, the situation is a bit different or more difficult because you have the ECB doing monetary policy for all of those countries. And here we don't see any further rate changes. Monetary policy is more or less neutral. So we've seen some tailwind with the rate cuts from 4% to 2%, but not further stimulus expected in the coming months with the cyclical recovery on the way. And inflation overall for the euro area as a whole being close to 2%. So no need for the ECB to change its current monetary policy stance. So that's the overall economic outlook. As I said, actually quite a constructive view. Of course, we have geopolitical turbulence, we have trade conflicts, but as I mentioned with AI, fiscal policy, monetary policy, those factors more or less compensate the negative impact from the others. So we are cautiously optimistic for the world economy as a whole, but especially also for Europe after some difficult years since the beginning of the Ukraine war in 2022. But let's turn to geopolitics, because as I mentioned at the beginning, a lot has happened here. I think it's not an exaggeration to say that we've seen the end of the rules-based international order in the last few months, and that is primarily or almost exclusively due to the pronounced changes in US security and trade policy by US President Trump. And I think this is well summarized by the yearly or annual World Economic Forum Global Risk Report that is published just a few days before of the annual WEF in Davos. And you see here the picture on the front of the publication showing the globe, the world at the edge of the precipice. So yeah, already making a statement with the picture. And it has a very important question that was already asked last year. So here we are asked business representatives, CEOs, but also academic people, experts were asked the following question: which of the following best characterizes the global political environment for cooperation on global risks in 10 years from now? And a very large majority of 68% said we will have a multipolar or fragmented global order in which middle and great powers contest, set and enforce regional rules and norms. Or to put it in another perspective, only 6% of more than 1,000 people who were asked this question said we will see a reinvigoration of the US-led rules-based international order. And this more or less summarizes what Mark Carney, the Prime Minister of Canada, said in an excellent speech at WEF in Davos. The US-led rules-based international order will not come back. So we agree with that statement. It's not just a transitory period of Trump causing chaos, and then after that we go back to the good old world that we knew. So the world has changed for good, and as Carney said, it's a rupture. It's not a transition. It's a shock, so to say, to the system. And nobody knows what the new world will look like, but it will not look like what we saw in the last few years and decade. That seems to be quite sure. So we don't think we'll go back in terms of US trade and security policy, independent of the question who will be the next US president. So I think this is an important statement by Carney and the view that we share. And this is supported by the National Security Strategy by the US that was published in November of last year. quite an interesting document because of its content, but also because of its language that is used, quite unusual for an official document from the White House. But those people who read that document carefully in November could already guess what would happen to Venezuela, what would happen to Greenland, and yeah, the aim to annex or control what is happening in Greenland, because the US quite openly stated that they want to reestablish full control of the Western Hemisphere. And the Western Hemisphere means North, Central, and South America. And they specifically refer to the Monroe Doctrine by US President Monroe in the early 19th century, who basically wanted to keep Europeans and everyone else out of the US, and especially also out of the backyard of the US, meaning Central and Southern America. And so we're going back to the 19th century, not only in terms of tariffs, but also in terms of national security strategy. And of course, Venezuela can be seen in this perspective. Venezuela holds the world's largest oil reserves and was strongly influenced with other countries the US doesn't like, such as Cuba, Iran, and China. And so it wasn't really surprising that they had a military intervention there and tried to change policy, and not only change the president, but also change policy there. And the same applies for Greenland, who also, according to the US, is part of that Western Hemisphere. And you also see some links that are relevant for Europe. So they try to preserve freedom and security of Europe, but there's also a hint that they want to restore Europe's civilizational self-confidence and Western identity. So they're highly convinced that Europe is not only weak, but also sick, and has lost its identity and confidence. And yeah, you can wonder whether current US policy really helps to change or cure that. But yeah, they seem to have some problems with Europe, and so it's not surprising with Greenland, and also the pressure that they put on NATO members to increase defense spending. This is all very much in line with this new national security. But a lot has happened as a reaction to US politics, and especially with the NATO summit last year agreeing to significantly increase the target for defense spending. So 2% was the target that only very few countries persistently achieved. As you can see here in the numbers last year, all the members were just about reached or were above the 2% target. But the new target is now 5%, with 3.5% seen for core military spending, and another 1.5% for security-related spending, such as cybersecurity, protecting critical infrastructure, and also supply chains. And part of that is also probably we'll be referring to industrial policy. So we will see a revival of industrial policy, not only at the country level, but also now officially with this new NATO guideline. So you can see that you can say that this is actually encouraging. So Europe was finally waking up and fulfilling its duty or its promises that it made years ago. So if there's something positive about the whole US politics, maybe that's one positive to take away from it, that they're taking up more responsibility for their own security and increasing investment and defense spending. But overall, with that picture from the WEF report, with the world just on the edge of the precipice, I think this is a bit over the top with that picture. I think one has to stress that the world is not about to fall off the precipice. We are not about to enter World War III. I think this is all a very exaggerated and also very Western Europe perspective on the world. And I would say, despite the end of that rules-based international order, I think the only region or countries that are really shocked about that is probably Western Europe, because the rest of the world probably never thought that we are living in a rules-based order. We had China and the US intervening all around the world for many, many years and in many conflicts. And it's probably only with the start of the Ukraine war and now with US President Trump that Western Europe realized we have to change something, and we can no longer just sit back and let the US take care of us in terms of rules-based order or international security. Because when you look at the global level, when you look at state-based conflicts since the end of World War II, you actually see what we came to know as the rules-based international order, and as a very peaceful period since 1990, since the end of the Cold War, was actually not the rule, but the exception, at least when you look at the last, say, 80 plus years. Because we had very little conflicts, or at least very little deaths compared to historical average between 1990 and the beginning of the Ukraine war. And I think this is something that Western Europe is now realizing, but the rest of the world was well aware of before all these recent changes. So as I said again, the world is not falling off the precipice. We're merely going back to the more turbulent times that we've had in the decades after World War II. And also regarding trade conflicts, obviously this is a strong and significant shift in US policy. But then again, this is US policy, and although we see some protectionist trends all around the globe, it's not like global trade is about to collapse. Quite to the contrary, global trade is still growing around its long-term average, so that's around 3% every single year, and this is goods trade. We never really talk about trade in services, but trade in services is actually growing even more rapidly than that one in goods. And you also see the same thing with global industrial production. So that again is still rising quite substantially year after year. So from a global perspective, US trade policy is basically just a blip. You actually see some front-loading effects taking place in early 2025. So companies anticipating or fearing that tariffs will be put in place, so they try to export as much as possible before tariffs hit them. And this is what happened. And then we see some slight setback after tariffs were put in place in spring 2025. But overall, not much has happened at the global level. And as I said, this has to do with the fact that it's basically only the US following this new policy. And the US is the largest economy of the world, of course, but it's also quite a closed economy relative to, say, European economies or also Japan. And this is reflected in that global development that hasn't really changed all that much. And you see it here in more detail. The left chart shows the share of US goods imports as a share of global imports. And we said last year to our clients, so this is not the end of the world. The US is only responsible for around 13% of global trade. And you see here, if you look at the monthly data, those numbers have actually fallen off a cliff. So it's really the US economy decoupling from the rest of the world, while trade in the other regions sometimes even intensifies. So we had a lot of trade agreements with Mercosur, with India. We also saw Canada trying to have better relationships with China. So I think as a side effect of US policy, the rest of the world might actually move more closely together, or at least cooperate more closely than it did in the past, to make up for that uncertainty or losses in market share in the US. And also US tariffs are partially circumvented. So we have a lot of tariff exemptions for certain goods, electronics, semiconductors, pharmaceuticals, gold, and others. And then we also have some transshipments, rerouting of tariff, especially from China to other countries. You see it here in the statistics in Vietnam, for example. It has to do with higher exports from Vietnam, but part of that also seems to be production from China that makes its way through Vietnam and then to the US. So tariffs are also circumvented to a certain extent. And the good news about that is this shows that companies are flexible, they're adaptive, and this also helps to limit the economic damage from those tariffs. So overall, you see China losing a lot of market share in the US, so less than 10% of US imports are now from China. But this is only if you look at the surface. Again, a lot of other imports from Asian countries are actually still produced in China. And then we have also the AI factor with Taiwan. You see the large jump in 2025. This is largely AI driven, so semiconductors increasing strongly, not only to the US, but also to the rest of the world. So a lot of reshuffling going on, changes in trade flows, but the overall picture or the overall damage is much, much smaller than we only look at the surface. So what is really happening with geopolitics? I think the most pronounced changes in US security and trade policy can be seen in the behavior of the US dollar, because the US dollar is still the world's global reserve currency. And this is not going to change anytime soon, despite the changes in US politics. What has changed is the behavior of investors. For example, when the war in the Ukraine, the Russian invasion started in early 2022, the US dollar was served as a safe haven. So many investors bought the US dollar to protect their investments. It was a safe haven, while as the gold price didn't really move all that much. Now, last year was pretty much the exact opposite. After Liberation Day, we saw a pretty strong depreciation of the US dollar, so around 10% in a short amount of time, while at the same time, gold price rose substantially. And this really hasn't reversed since then. So gold especially seems to be the preferred safe haven now, whereas investors seem to have lost some confidence in the US and US politics and try to diversify away from the US dollar. And I think this is really something that will remain with us in the coming years. I mean, the dollar is not weak. It's still relatively strong from a long-term perspective, even if you look at the last few years. So it's not a weak currency again, and it will also remain the most traded and reserve currency of the world. I don't think any currency can take that role anytime soon. The renminbi is not really fully convertible. The euro could be next in line, but it's still a long way to go there. So these are slow changes, but probably also persistent changes that we'll continue to see in the next few years. And so the other conclusion is gold will remain attractive. We have seen a very strong price increase in last year, but also the first few weeks of this year. But we still think there are a lot of supporting factors for gold. And the most important one is that gold purchases by central banks and financial market investors continue. Especially central banks. I mean, the Polish national banks is actually the central bank with the highest amount of gold purchase globally. That was the case in 2025 and also be the case this year. So this is one very important factor that continues to support the gold price, and central banks trying to diversify away from the US dollar by buying more gold and selling US dollar and US treasuries. And then, of course, with interest rates coming down, opportunity costs are also falling. So this is, from a relative perspective, making gold more attractive. Unpredictable US politics, I think I already mentioned that. We have seen some inflation fluctuations and uncertainty, not only due to tariffs, but other policy changes, be it subsidies for energy, food, and others. So some uncertainty regarding inflation, and gold could provide an inflation hedge for that. And then also a general global trend is very high and rising government debt, especially in Western advanced economies and also in the US. And we don't see really an end or a change in trend regarding that factor. That also supports gold because it makes treasuries and other bonds, government bonds, rather unattractive. So let's turn to artificial intelligence and what its impact on the economy and markets is. I already said at the beginning, it was a very important driver of economic growth in the US last year, but it continues also to be a very important driver of financial markets. And I'd like to elaborate a bit more what's behind it. Of course, the question we also always get asked by clients, is it all just a bubble? Are we just in an AI bubble and the bubble will burst anytime soon? So I'll try to elaborate a bit more on that, and what also, more importantly, we can expect from AI in terms of economic changes and performance in the next years. So let's start with some good news here. I mean, those who fear that we will all become unemployment because of AI in the next few years, I would at least say we'll start from very good points, or the starting point is good in terms of that unemployment in most countries is quite low. And perhaps more importantly, the employment rate is close to an all-time high, meaning that the share of people in working age who are actually employed or looking for a job is as high as it has never been before. And this has to do with the fact that especially older people, so this means age 55 plus, the share of those has risen substantially, and was also risen substantially is the share of women in the workforce over the last 20-25 years. So this is actually a very positive development, not only in Western Europe, but also in Central and Eastern Europe. So the starting point, even if artificial intelligence were to be a big shock for the labor markets, is that we're at least starting from a very good point and should be able to absorb, even if there were some kind of AI shock in terms of employment. But then again, further good news is that at least so far, the impact on the labor market has not been especially disruptive, at least not yet. The left-hand chart shows the share of US employees who have found a new profession or were forced to find a new job compared to the start of the beginning. Compared to the beginning of the new technology. So here we took November 2022, the introduction of the ChatGPT, and compared it with the introduction of the internet, or the beginning of the computer revolution in the 1980s. And you see a little bit more impact than during the internet boom or the computer revolution, but overall the changes are quite similar. So we've seen around 5% of US employees in a new profession compared with 3 years ago. So this is a bit more than with the internet boom and computer revolution, where we were around 3.5% or 4%, but not really dramatic or that much different compared to other revolutions or technological breakthroughs. So this is more like comparing it with previous technological cycles, but the right-hand chart is a more long-term perspective, overall perspective on the US labor market, and you see here that we've actually seen very little structural transformation, not only in the US labor market, this applies even more for Western Europe over the last few decades. The most turbulent times have actually been the 1940s and 50s, especially after the end of World War II. There were a lot of changes, politically, economically, a lot of economic growth, of course, and with that new needs, new desires for workers, employees and firms. And since then, we've had quite a significant slowdown. So unless the 1940s and 50s, we are now very much a services-driven economy. Services are responsible for around 80% of all employees, and those tend not to change overnight, despite AI. So AI might also, of course, affect the services sector, and I'm working the financial sector. There's a lot of potential for AI in the financial sector. But that doesn't mean that we all become unemployed in that sector. Quite to the contrary. I mean, the biggest drivers of employment right now are government-related sectors such as health, education, social services, and this is a very strong structural trend, also driven partly by demographics. And so I don't think we'll all become unemployed. Quite to the contrary. And there was a very big report by the World Economic Forum last year on the future of jobs, based on a survey among very large companies all around the world. And those companies actually answered that they expect an increase of AI on employment, not a decrease. So of course, some jobs will disappear because of AI, but others will also be created just because of AI. And net, they expect an increase in employment. So that's actually quite encouraging as well, not also in terms of productivity or profit margins of firms, but also in terms of employment. So we don't have anything to fear in terms of AI, that we'll see mass unemployment in the next few years. Quite to the contrary. And this has actually been the case for many decades, that new technologies, they're responsible for progress, higher productivity, and not lower productivity levels or as I said, even mass unemployment. So history tends to repeat itself here as well, and the positive news far outweigh the negative news or changes with this new technology. But to be a bit more precise, what can be expected in terms of labor productivity growth? I mean, some optimists argue that within a few months or perhaps years, all we have to do is sit back and just push the button and AI will solve all our problems for us. And just like the pessimists, I think this is far, far too optimistic because, as I mentioned, with previous technological changes or progress, yes, productivity rose over time, as you can see here on the left-hand side. The long-term average for the US is around 1.6% per year. So this is for the entire economy across all employees. So it's not super high. It's less than 2%. And it was even substantially below that in the last 10, 20 years. So this is only the long-term average. But you see that since the 1960s, there never was any leapfrogging, not with the computer revolution, not with the onset of the internet, and probably also not now with the introduction of or the spread of AI, but rather this has been steady progress instead of big shocks to productivity. And on the right-hand side, you see some academic studies on the possible impact of AI on overall labor productivity. So this is not individual productivity or firm productivity, but for the overall economy. Of course, you always need some assumptions when you make predictions like that, but you can see here the most recent studies on average find an impact of around 0.3 percentage points per year. If you compare that with the 1.6 long-term average, so you can say around 20% more perhaps, or we're going back more or less to the long-term average because the last few years we've been below that, but it's not really very, very dramatic, despite, of course, at the individual level, AI can have very profound changes or can help productivity significantly. But the good news is, yeah, I mean, the timing of AI could be just about perfect because, as I said, labor market generally in good state. And of course, we also have demographic challenges. Working age population is falling almost everywhere, at least to the most reliable predictions from the United Nations population division that you see on the left-hand side, especially, of course, also Western, Central, and Eastern European economies. And I've shown the other chart on the right-hand side, I think, before, that labor scarcity, especially in Europe, remains a big concern for companies. This is here for the services sector, but the same applies for the manufacturing sector. So just in the nick of time, you could say that when the older workers leave the workforce and the younger ones are not as numerous to replace them, this could actually be just perfect timing for AI to step in and help boost productivity and make up for those workers that are lost due to retirement. Of course, there's no guarantee for that. There could be a potential mismatch in the labor market. This is something that economists always look at. So it could be that AI replaces people that would be replaced anyway. So it's only accelerating the structural transformation. For example, it probably won't replace nurses or engineers that are very scarce today. They'll probably be scarce still tomorrow despite AI. So there could be some mismatch, but overall, I think there's a potential for AI to mitigate some of those demographic challenges that we face. And then perhaps more importantly for investors and also for you or the general public, we don't see any signs of an AI bubble in financial market and particularly the equity market. This chart shows the relative earnings growth, so profits of tech firms in the Nasdaq relative to the overall US equity market, the Standard & Poor's 500. And you see in the dot-com boom or bubble, there was a strong divergence of relative equity performance and relative earnings growth, meaning equities were rising strongly, but it didn't really have strong fundamentals for it. It was just hopes and expectations that at some point profits would follow as well. And as you all know, in most cases, they didn't. And so we had a collapse of valuations and equity prices once again. Nowadays, however, on the very right-hand side, the picture is completely different. Yes, we've seen a strong outperformance over the last years by the Nasdaq relative to the overall US equity market, but this was very strongly driven by actual outperformance of earnings. So meaning that tech firms, unlike in the dot-com bubble, most of them are now highly profitable profitable. They have very little debt, and so they are able to finance all those high investments that are currently taking place, even if some of those investments would turn out to be bad investments. Or to put it differently, if they were investing less today, their profits would be even higher, and probably their outperformance in the equity market would be even more significant. So the situation is quite different from the late 90s. And as I said, we don't see any signs of an AI bubble whatsoever. And we continue to believe that tech firms are really good investments, even today at today's elevated valuations, because they're supported by high profits today and probably even higher profits tomorrow. So to summarize, I think this is a good picture to summarize how we see the world today. Overall, a blue sky, of course, some clouds, some scattered clouds, some are darker, some are more white. But overall, as I said at the beginning, the glass is half full, it's not half empty. We see slightly more positives than negatives. So the overall outlook, despite the geopolitical risks, is quite solid. Economic growth remains moderate, but also surprisingly robust. Supporting factors, I mentioned AI boom, fiscal and monetary policy, they continue to be tailwinds in 2026 and possibly beyond. US security and trade policy is quite shocking to say the least, has far-reaching consequences, and has especially far-reaching consequences for European countries. But I think by now, most European governments have realized that, and they have reacted. We've seen the REARM EU program last year. We've seen national efforts to increase defense spending. And I think there were also more efforts for international cooperation in terms of trade. I mentioned India. Mercosur has been rejected for the time being now by the EU Parliament, or at least put aside. But nonetheless, I think one conclusion or one lesson middle or small powers, including Switzerland, can draw from all this is that they should cooperate more closely with allies. And I think this is also what will happen. So it'd be more like the US being more isolated from the rest of the world, and the others could in fact cooperate more closely than they did before. And on top of that, as I said, AI, it will enhance productivity and mitigate demographic challenges. It most likely will not solve all our problems in the foreseeable future. But then again, on the other hand, it also will not lead to mass layoffs or unemployment. And we see no signs of an AI bubble, quite to the contrary. Equities are driven by profits. And so equities in general, and especially those from tech firms, also from financial firms and pharmaceutical firms, we still see a lot of potential there. And so I'd like to close on this more positive note that the world in general, but also the economy and financial markets are in a much better and robust state than most media would like you to believe these days. So I'll close here, and I'm looking forward to hear your comments and questions.
Thank you, Martin. That was very, very rich in information content, and I'm very happy about the positive outlook. So since we're already over time, but still, who has a question? So please put it in the question and answer button. Now, do you guys at Tech about also thinking in risk scenarios? I mean, if now Trump goes completely overboard and he kind of basically what it looks like, honestly, tries to go down, the path that some of my friends from Central Eastern Europe tell me often, that this is like a playbook on how to establish a bit more of an authoritarian regime. Somebody told me from Hungary that this is one, it's a one-by-one copy of what has been done there, what Trump is doing now. Now, if the democracy would, cease to exist a little bit in the US, I don't know how the Western world would react and what would be done if he goes to Greenland or Iceland, how he calls it. Anyway, do you think in scenarios like this, is that something that you guys think is likely? And if it's likely, you're saying, well, sorry, we economists, it will not hurt the basic fundamental economic outlook, or just a little bit an open question to you?
Yeah, it's a very important question, and the part of the answer is yes. Of course, we think in scenarios. We have to in today's turbulent and unpredictable world. But to answer your question, of course, that's not the baseline scenario. But yeah, as you said, it's actually the biggest concern, at least for myself. It's more about what way is U.S. democracy heading. This is my bigger concern than trade politics, and what he talks about Europe is actually what happens to U.S. democracy. But overall, we believe that U.S. Institutions are strong enough to withstand the Trump 2.0. They did it with Trump 1.0. I think they will be able to hold their own against Trump 2.0, but it's quite concerning, yes. But we have midterm elections in the fall, and some are already saying there won't be any elections. I don't think this is likely, because we've seen quite some unrest in the U.S. as well, in several states and cities. So there's some resistance. And most likely the U.S. government will be punished in the midterms for its current policy, because if you look at surveys, most people are quite unhappy in the U.S. with the way the country is going, with the priorities that U.S. President Trump has. For example, trade, Greenland, and all those things. Those are not their priorities. Their primary concerns are the economy, the labor market, inflation. And Trump has done very little about that, so we think there will be some backlash, political backlash for current U.S. politics. But then also what you mentioned, the other factor, yeah, that could indeed be the case, that the U.S. goes down the wrong way in terms of democracy and political developments. But at the same time, the economy holds up rather well. So yeah, as an economist or even as a strategist, you could conclude this is very worrying. But in terms of economic performance or financial market performance, not much changes. I mean, we've seen that in other countries as well. And you mentioned Hungary. It could still be that the economy holds up relatively well. The U.S. economy remains very competitive, very innovative, and this won't change overnight. But yeah, something we have to be very aware about where things are currently heading. But we are not that.
I only mentioned negative. Hungary as not putting the finger on Hungary, but. It's just somebody that told me this, so that's not my personal opinion. Well, and if it's my personal opinion, I wouldn't say it here. Let's say, put it this way. Anyway, we have a question. It's about weakening the Swiss franc is a bit of a pain, right? And we haven't touched on Switzerland really, which would also be interesting to know. Another safe haven, of course, is the Swiss franc, as we have seen. We have record high of Swiss franc, and I don't know if now, but kind of like in the last couple of days. And I think this new president of the Swiss National Bank, or the director, I don't even know, he seems to be really not wanting to go into the negative interest rate territory, at least at the moment. And do you think that, will or is Switzerland's national bank using FX rates to try to weaken the Swiss franc and this whole situation in Switzerland? And just one more thought, and maybe we can finish with a thought on Switzerland, because we didn't touch so much on it. But if you talk to the major industry association like Swissmem, etc., and I know you took a very high level of view on the global economy, but talking about Switzerland was being hit because we have in our trade deficit gold, and we have pharma, which are by far the biggest part of our trade deficit with the US, but they were excluded from tariffs. And the ones who were not excluded, like watches and the small machine maker and all the good products that are world class and have now those 15% still of trade. And you see a bit unemployment rising in Switzerland, etc., etc. So the one question, what is Switzerland doing to weaken the Swiss franc? And the other bigger question, how do you see the Swiss economy doing?
Yeah, big, important questions. To make it short, we don't expect negative interest rates by the SNB. I think President Schlegel has made it clear that the hurdles for that are relatively high. They are well aware of the side effects from the previous experience between 2015 and 2022. So they will have to think twice to put that back into place. They know that transmission through banks and interest rates doesn't really work as well as with positive rates. So we don't expect that. And then, yeah, the more likely scenario is that we will see FX interventions again if the Swiss franc keeps rising. But I think there the hurdles are relatively high as well, because this is a structural trend. The Swiss franc has been appreciating for many, many decades. And as long as this doesn't happen like a shock, like it did in 2011 or 2014, 15, like say 10% within a few days or weeks, I think the SNB will be hesitant, because the risk or the problem could always be that you'll be marked a currency manipulator by the US government again, and so you run into trouble there as well. So unless the Swiss franc appreciates substantially, we don't think big FX interventions are likely. So the most likely scenario is that the SNB won't do anything. And yeah, in terms of Swiss economy, not really doing well. I agree. We expect below average growth again this year. But as I said at the beginning, with the recovery in the global manufacturing sector, and also the recovery in Europe and Germany, the manufacturing sector in Switzerland should profit as well. And we should see some slight recovery this year as well. But Switzerland really has some growth issues, not like Germany, not as much as Germany, but yeah, has to find, I guess, or innovate its previous growth model. But just exporting to the US and the rest of the world isn't working as well as it did in the past. So definitely some challenges as well for Switzerland.
Okay, super. So, Martin, I guess you're hungry. You've given us so much food for thought in your presentation. So thank you once again for this great outlook. Again, very happy. Good outlook for Central Eastern Europe. Also very happy. And in Switzerland, we keep fighting to do what we can do. And as a Chamber of Commerce, we also try to do our little contribution to make economy grow a bit. So Martin Weder, and to all of you, I wish you a great lunch and afternoon, and we'll see us next month again with something about the future of mobility, where we look at, is hydrogen going to win the war, electricity, oil, or whoever. So anyway, thanks a lot and have a great day.
Thank you. Bye-bye.